You are listening to Mining Stock Education.
This is true more than any other sector. Is bulls make money, bears make money, and pigs get slaughtered. And I was a pig that lost a lot of my gains in 2008, right? I remember going to the VRIC investment conference in Vancouver in January 2008, and it was off the hook, right? I mean, there's young people running around. You never see young people at conferences. I even saw hookers, and you never see hookers at a mining conference, right? So I was like, you know what? I need to sell some. I think I sold 25% of everything or something. It's like, I should have sold a lot more, obviously, because look what happened in 2008.
Thanks for tuning in to Mining Stock Education. I'm your host, Bill Powers. And in today's show, it's our monthly check-in with David Erfle from Junior Miner Junky with the Y.com. And in today's show, you're going to hear a little bit of David's story if you haven't already, and just make this real. There's many retail investors out there. I see the comments, I get the notes, wanting to multiply your wealth, gain some more freedom through wealth multiplication in junior miners. That's something that David was able to do. But David, at times, it's not without anxiety, right? You made a lot of money in that run up into 2011, 2012. You traveled the world. In 2013, you become a first-time father. And then in 2016, you're married. You got a little kid. Take us to that point. What do you have in the bank account, and how have you built it up over the last decade?
Yeah, Bill, it was a wild, crazy ride. You know, I got into this sector in 2003. I discovered it, and I was remodeling my home in Pasadena, restoring it, and doing all the work myself. And I'd made all this money as the real estate market took off into 2005. And I said to myself, you know, I really don't want to be work a slave to anybody else. I'd kind of like to be my own boss. So I sold my house and put all the money into juniors, and did really, really well. Like you said, traveled the world and all that. And I met my current wife in Bali, and then we had a son, and I said to myself, you know, I really can't be a seat of my pants Wild West trader anymore. I'm gonna have to have some cash flow and some guaranteed income coming in here to take care of my family. So fortunately for me, you know, I ran into I met Daniela Camboni of Kitco in the early 2000s, and, you know, talked to her at conferences, and several other people. You know, I made some contacts, and then she asked me if I wanted to write a column for Kitco. And I said, sure, that would be great. That would be a great opportunity. So I started to write the column, and then I got all these emails from people telling me that I should start a newsletter. So like I said, you know, I just had a son, and I had a wife that wasn't working. So I started the JMJ newsletter, but I wanted to make sure that it was different from other newsletters, and the fact that it took advantage of being an over-the-shoulder service where I would provide my account, show people what I buy, what I sell, how much I paid for it, how much I made, how much I lost. And I would tell them ahead of time. I would telegraph what I was going to buy or sell before I did it. And no other newsletter at that time was really doing that. I mean, it's full transparency. Nothing is hidden. Everything is revealed to my subscribers, and it really took off. It really worked. And, I've done really well, and I've made a lot of people a lot of money. And, it's like I said, it's been a wild, crazy ride. And now, you know, the last few years before 2005 were kind of hard, but my subscribers, God love them, most of them stuck with me, and we were able to accumulate the best of the best juniors. We had all this time to do it because, you know, back then, in 22, 23, 24, you know, juniors were loathed. They were sold short. You know, the street was playing games with them, but we accumulated the best of the best, and we're really patient. And, we stuck with gold, silver, and copper. And coming into 2025, we had the best of the best of these companies, full positions. And now, gold, silver, and copper have all made all-time highs in the same year for the first time since 1980. And the JMJ portfolio, the real money JMJ portfolio, which began with $500,000 of investment, is now nearly 1.5 million this year, and it's up over 250% in 2025.
And how much cash have you taken off of the table in the last decade as well?
When I started the service in 2017, average realized gains have been 700,000. So it's been an average. So if you got into the newsletter, when I started it, you've had an average realized gain return every year of 20%. And that's real returns. And that's basically in a bear market. The juniors, I'm sorry, they've been in a bear market. Coming into this year, they'd been in a bear market for the past decade plus. We basically had the generalist investor get out of this sector in 2013 and haven't really come back. I still don't think they've come back yet. I mean, they're starting to come back now. But if you take a look at the volumes in GDX and GDXJ, and especially the TSX Venture, they're very low. They're not indicative of, even though GDX and GDXJ are up over 130% this year, the volumes aren't indicative of a mania yet. I mean, they've outperformed everything as far as I know. And, we still really haven't got, even though, the sector's technically overbought, has been technically overbought for months and has remained so, we're still underinvested. I mean, high net worth investors, I think 0.5% are in the sector. And just recently, these money managers, Goldman Sachs, Morgan Stanley, they've come out and they've readjusted their views about the 60-40 portfolio. For decades, it's been 60% stocks, 40% bonds. That's what you should be invested in. And for the first time in decades, now they're saying 60, 20, 20. You're saying 60% stocks, 20% bonds, 20% precious metals. And some, like even, bond king Jeffrey Gundlach has said 25% stocks, 25% bonds, 25% precious metals, and 25% cash. So for the first time, you've got the street, you've got Wall Street and investment banks recommending precious metals. That didn't happen. It wasn't happening when I got into this sector nearly 25 years ago. I mean, gold stocks weren't even paying dividends. So, your generalist investor is still completely preoccupied with AI stocks, and up to recently, even crypto's has tanked now, and it's down. I think the crypto sector's down like 15% this year. Gold's up 65%, and silver's up over 120%. So, if you're a generalist investor, you take a look at a gold chart, you take a look at a silver chart, and you get discouraged. You say, "Wow, I missed it." Well, you haven't, because if you take a look at gold stocks and silver stocks, the shares are still catching up to the metal. They haven't even come close yet. I mean, gold in the ground is trading at less than $60 an ounce in most of these projects that are being de-risked, and silver in the ground is trading between $2 and $5 an ounce, even though it just hit $65 an ounce here last week. And for the first time in history, you could buy a barrel of oil with 1 ounce of silver.
So Dave, you've been successful. We just laid that out. And a critique that you might see is, well, Dave is too positivistic on the juniors. He's too perma-bullish to where he might miss selling at a cyclical top. Now, you've already taken initial cash off the table. You've shared that, right? So you're de-risked.
In several companies, yes.
Right. But you have a $1.5 million portfolio. You don't want to give that up, but you're leaving that in the market because you believe things are going to go higher. So what would you tell listeners about how you're going to manage time in the peak of this cycle and selling?
That's a great question, and nobody ever gets it completely right. I mean, that's, anybody can buy an undervalued stock. It's easy to do that, but selling and getting the most out of your investment to try to sell the top, that's, it's impossible. So what you want to do is you want to trim your big positions as they get bigger on the way up. I have investment rules. I've shared them with you in the past, and I've gotten heat for them. My original reason for getting into a junior, my first goal is for it to at least triple. I'm getting into things that if I don't see at least 3 times upside, I'm not even going to bother with it, because these things are, they're highly speculative, highly risky. And if I'm going to put my hard-earned cash and recommend them to my subscribers, then I want to make sure that they have a huge upside. So there's 6 companies now in the portfolio that have tripled, and I've taken a third of my investment capital off the table, which covers my investment capital. Right, a third of the stock has been sold, which covers my investment capital. I take the gains and I bank them, right, and then I take if I sell something of the original investment capital, then I put it into something else. And I've done that with a few stocks, and they've gone up even more than the companies that I've sold, that I've taken profits from. I've taken some of the investment capital off the table. My biggest gainer I've shared with you before is Montage Gold. We've got a over 12 times gain in that stock now. I've trimmed it a couple times. So when a stock gets too big of a position for your portfolio, you trim it, and you either bank the cash, or you put it into something else that's maybe higher risk and further down the totem pole that really hasn't moved yet. And that's what I've been doing with the companies that I've taken the cash from. I'll move down the higher risk totem pole in the sector, and I'll put it in a company that maybe just put out a mineral resource, or they just put out a PEA, and there's still a lot of de-risking yet. Hence, there's going to be a lot more dilution. So, the more dilution that is on the horizon in a stock, the higher risk it is.
Are you willing to take on more risk in a specific company now in pursuit of some higher gains at this point in the cycle?
Yes. Plus, you're sitting there with all these profits. You're doing really well. You're making money for your subscribers. And just recently, for the first time in like 3-4 years, I invested in a drill play, because there really wasn't any reason to invest in drill plays in the past 3 or 4 years, because gold in the ground was so freaking cheap. Right? Why should I take a flyer on a company that's looking for gold when I can get all this gold in the ground that they're de-risking this fantastic project for, less than $20, $25 an ounce on the ground? It's still cheap at less than, most of them trading for less than 60. But, a lot of these companies have doubled, tripled, quadrupled. And fortunately, we hold a bunch of them in the portfolio. So, like I said, recently I took a flyer on a higher risk junior. This junior had drill play, and this junior has a huge land package in a top tier jurisdiction. They got a bunch of cash. They're totally cashed up through next year. They got a bunch of drill targets. And this is something I figured it was worth to take a chance on.
And what about jurisdictional risk? Willing to do that a little more at this point in the cycle?
Absolutely. Yeah. I just added a company in I also, it's not advertised on my website, but as a courtesy, I also share my my SEPI retirement account with my subscribers too, and that contains lower risk companies, majors, mid tiers, and I just made an investment on a junior silver company. They have a big board listing, so I can include it in the account. And they have really high leverage to silver, but it's in a higher risk jurisdiction. So that's what's happening. That's what these investors are doing now. They've made all this money in these lower risk stocks, in your miners, in your juniors that are at the feasibility stage or the finance stage, or they're constructing their projects. They're fully financed. They've made all this money in these companies, and they're taking some of their profits and they're going down the higher risk food chain in the totem pole, and taking a flyer on some of these higher risk companies. And that's where the real value is now. Sure, I still think there's good value in these companies that have already tripled, quadrupled. Because like I said, the gold in the ground is still trading at less than $60 an ounce. You take a look at what happened, at the peak of the last bull market. We had FOMO in executive. We had this conversation before we started. We had FOMO in these executives even making these deals for paying $1,000 an ounce on the ground for gold in third world countries. So, we're not even anywhere near anything like that yet.
Dave, let's talk about that. We see these silver companies, Vizsla Silver, Endeavor Silver, First Majestic Silver. They're coming up with these great financing at terms that are very favorable to the companies. I want to put this First Majestic Silver one out there. $300 million US, 0.1% interest for an unsecured convertible senior note that's due in 2031. And Dave, the conversion price on that is US $22.36 per share. We're at about $16 per share right now. So there's big money that basically wants a call option on these silver shares, right?
Yeah. Smart. I mean, it's funny. One of my top 10 holdings is Vizsla Silver. And we got into this company several years ago after I did a site visit. And I just thought, wow, this is a no-brainer. I got to get my subscribers and myself into this one. And we've done really well in it. And basically, Vizsla was the company that started off this corporate bond wave in the silver space. I was talking to Michael Connert, who engineered this fantastic deal for them. And he said we saw it happening in the uranium space. So as soon as Vizsla did it, that followed, Endeavor Silver did it about a week or so later. And then First Majestic, that you just brought up, did it a week or so after that. So this was all kicked off by Vizsla at the end of November. And so we're probably going to see more companies doing this. And so now a company like Vizsla has twice the amount of cash they need to build their Panuco project. They don't have to have a debt facility. They'd already started to do a deal with Macquarie for a debt facility. And then they did this deal instead, and that cancels that debt facility. And it wasn't finished yet, so they didn't have a penalty on it. So this is fantastic for these companies. And now, like I said, Vizsla has got twice the amount of capital now to build Panuco. They don't have to do any debt, so they're not a slave to bankers and to what they need to do. They could do whatever they want to do. And now they're already looking for the next Panuco while they're waiting for their permits to build the first one. And they're expected to be in production in early 2027.
Dave, a lot of these silver producers that trade on the big board, they can kind of have these at the market facilities to where from the corporate treasury, they're diluting shareholders by selling shares into the market for cash. Investors sometimes aren't aware of this. What are your thoughts on silver producers using this facility?
Well, if they do it responsibly, then, I like it. Endeavor Silver's done that. I hold this stock in my retirement account, Endeavor Silver, and I've done really, really well with it. And they've done this. They've gone into the market and raised money to do this. And like I said, they just did the corporate bond offer too. So with the silver price doing what it's doing, and it's doing what it's doing, not on speculative interest. It's doing what it's doing because there's a supply squeeze. Last Friday is a great example. We had Friday. The CME always does this on a Friday when silver price is getting out of control. That they announce a margin hike. So they hike margins 50% on Friday. Silver, price goes down like $3-4 to something like that in a matter of minutes. But it didn't keep going. It was bought. Because this is a physical squeeze, not a paper speculation hockey stick. So, we're having the silver market is super tight, and there's just not enough silver. We're in a fifth year of deficits. So, and if you take a look at the silver price adjusted for inflation, if you take a look at the silver price, CPI adjusted for inflation, the high it hit back in 2011 was $49.50. If you adjust that for CPI inflation now, the price is $71.50. But if you go back to when it hit $50 when the Hunt brothers were trying to corner the silver market, and that was stopped, by the way, for for margin increases, and also just them changing the rules on the COMEX because they could. It was they're trying to illegally quarter the silver market, so they stopped that, and it turned into a long bear market. But I digress. So if you take that price that silver hit back in 1980 and adjust that for CPI inflation, it would be $200. So this is why you guys got guys like Michael Oliver coming out and saying silver could be $200 an ounce within 6 months. And it's not a crazy prediction.
Another silver company you own that you've been on record is Dolly Varden Silver, and they are merging with Contango Ore. Contango Ore actually has cash flow. I think it's something like $100 million a year via direct shipping to Kinross's mine there in Alaska, mill, excuse me. So what do you think of this? Dolly Varden's going to have cash flow, huh?
Yeah, I mean, it's crazy. My top 10 has had so many game-changing announcements happening for the companies. We've done really well with these companies. And Dolly Varden, this is a really positive deal for Dolly Varden shareholders, because before this deal, Dolly Varden was a high-risk pre-PEA stage explorer with a flagship project that's going to require a lot more dilution, because the high-grade Salt Valley project, it's not expected to be in production until the early 2030s. So they had massive dilution ahead of them, right? So all of a sudden now they've got cash flow to de-risk this project, and the Contango projects are also good, are really good, and they're low capex because it's the direct shipping ore model, right? Where they don't have to build a tailings facility, they don't have to build a mill. It's cheaper to just direct ship this ore to a mill. So they've got so now the merged company is going to have like $140 million in free cash flow and about the same in cash. And also both companies had really tight share structures. Dolly Varden wisely rolled back their share structure I think about 6-8 months ago, and it got a big board listing. So they only had about 90 million shares out, and Contango only had about 15. So combined, this company's going to have about 31 million shares out and a big board listing. And what Contango didn't have was they didn't really have a retail base. Dolly had that. So Dolly's going to get positive free cash flow, and Contango is going to get a nice retail base, and they're going to have silver exposure. So the combined company is going to have some nice silver exposure, and they're going to have silver projects contained in very large land packages, in district scale size land packages, and I think all of them are subject to the DSO model. So the Salt Valley project is close to a port, so they can DSO that project also. So this is a very positive deal. I think for us, for my subscribers and we're Dolly Varden shareholders, and I really like the deal.
So with these silver companies that you've owned, another one was Discovery Silver. They did a transformational acquisition in Canada, moving out of just being in Mexico. And what has been your gains in that stock since they made that acquisition?
Oh yeah, we've got almost a 7-bagger in that stock now since they made that deal. I mean, we got into the stock a long time ago. So I already had my investment capital off the table in that stock before they did the deal. So yeah, I mean, they picked up Porcupine, a mine complex in one of the best mining camps in the world, for $25 an ounce in the ground. They stole it. And now then Silver Tiger, a Mexican junior that's de-risking an open pit project, but it's in the early stages. They got an open pit permit, and that was a game changer for all these companies in Mexico now that are in line to get permits. And Discovery's Cordero project is one of them. So they're getting re-rated because of Cordero, and they're getting re-rated because of the incredible potential of the Porcupine. I mean, Tony McCooch just came out and said that they see production doubling there. So it's just a fantastic deal for this company that Newmont monetized Porcupine, and they picked it up, like I said, for nothing.
Okay, so we've brought up and discussed some companies that you own that did deals you like. you've held. What about a recent company that you've owned? They did a deal, you didn't like it, you sold. What can we learn from that, Dave?
No, I haven't sold it. Are you talking about Probe?
Well, no, you weren't happy about that buyout price, but I'm just saying in general, when's the last time you held a stock that when they did a deal, you didn't like it when it was announced to where you sold?
Oh, okay. Probably '03. I got into '03. My subscribers and I got into '03 really early. This looked like a no-brainer for a multi-bagger. It's funny, and you get into companies and you look at them and you go, "Wow, this is a no-brainer for a multi-bagger." Those are the ones that usually don't give you the multi-baggers. It's the ones that you think, I'll take a flyer on this and maybe I'll get lucky. I'll do all this due diligence. It looks like it's good, but I don't know if the market's going to like it. But let's get into it. See, those are the ones that end up making you all the money. But anyway, I digress. As far as '03 is concerned, Agnico took them out. They got it really cheap, and I figured the stock would go a lot higher. They had a tight share structure. They're in a great jurisdiction, but I don't think management really did a good job with the company. But we made a little bit of money, so I can't really complain. But it didn't make as much as we thought. And then Probe is another one that we've got a 4-bagger in it, but now we're waiting to see if there's going to be a bidding war, which I'm hoping happens. But it's an all cash deal, so you have the luxury of just waiting. And if it doesn't happen, you just sell it in January when the deal is expected to close, and then you don't have to pay capital gains tax right away. You just you're able to delay the capital gain, paying the capital gains for other 14 months. So that's another reason why I'm continuing to hold the stock.
So if a company you own is being acquired at the announcement, if it's a share for share deal, you're more likely to sell it, right? Upon the announcement than if it's a cash for share deal, right?
Well, it depends on the situation, share for share. If I like the company, if it's a mid tier or the growth oriented producing mid tier, and it looks like they're doing the right thing. They've made some deals and they look like they're going to grow. But if they look like they're going to grow with more dilution, I say, nah, I'm going to go ahead and sell it. So I did that with Marathon when Equinox bought Marathon.
You did it with another one in an African producer, right?
Endeavor. No. Started with a T. Teranga. Yeah. Endeavor bought Teranga. I think it was Endeavor that bought Teranga.
There was another one you had too, Dave. I'm not recalling it, but you had another producer. It was either Beatty or Pierre Lassonde was involved in it. One of the founders of that producer. Anyway, there's been a number of them. I can't recall
so many. Yeah.
Yeah. I can't recall the name at this moment, but I believe you held that one because you saw growth potential, if I recall from reading your writings as well.
Okay.
So
I
guess the takeaway point for listeners from an educational standpoint is, what's the answer? You can have general ideas or rules of thumb, which you do, but it's always situational. It depends. Oh, yeah. It depends on the markets.
Case by case.
Yeah.
You have to take it on a case by case basis. Every single deal, every single company, there's such a high risk sector, and there's so many things that go wrong. It's funny. Something come out of left field and go wrong that you never even anticipated.
Who bought Gold Standard Ventures?
That's it. Yeah, Gold Standard Ventures. Orla.
Yes. And isn't Pierre involved in Orla, if I recall?
Yes.
Okay.
Yes. When I sold that. Yes. Okay. We didn't make a lot of money in that one either. It's funny. I've been following that stock for so long, and it's a company that they totally over drilled that project, that railroad project. They spent too much money, over drilled. The stock price just, as they continue to dilute. And, when you're diluting too much in a bear market, nobody gives a shit about drill results, the stock's not going to do well, which is a reason why I've stayed away from drill plays over the past 3-4 years. But it's, we ended up, I think we broke even on that one, but glad we sold it because we got into something a lot better. And I'm sure the stock is doing a lot better because most of the companies in my portfolio are doing really well. So it's the age old theory. You just got to you got to take a big position into a sector that is loathed and that has been loathed for a very long time. And you see the potential and you see the horizon and you know it's going to happen at some point, but you don't know when. So what you do is you just accumulate as many shares as you can in the best of the best companies. Don't put too much money into any single company. I don't put any more than 5% of my investment capital into one company because, like I said, you could pinpoint something and say to yourself, "Oh my God, this is a no-brainer. This is going to make me and my subscribers so much money. Let's just load the boat in this one and put 10, 15% of our investment capital into it." That's usually the one that takes a shit. and I can tell you which one that was for us recently. It's I-80 Gold. That company looked like a no-brainer to me. I got myself and my subscribers into it, and it was one of the duds that I had. I didn't have very many of them, but it was one of the duds that I had because they had too many projects. They over diluted in a bear market. They had all these drill plays, but they were fantastic properties, and they just built up too much debt, too many shares, too many warrants, but it just caps the upside in the stock. So I ended up selling it for tax loss.
So you just admitted a loser. A lot of newsletter writers won't even publicly talk about their losers because it doesn't help sell subscriptions. Right. Come on. We have winners.
Part of it, man.
Right.
I mean, it's what makes this sector exciting. It's hard to make money in junior resource stocks. It is very difficult. That's why I love it so much. It's the ultimate challenge. Right. I mean, if you use the baseball analogy, right? If you're Ted Williams and you can hit 400, you're going to be a superstar. That's 4 out of 10, right? So, that's just the way the sector is. But those 4 could make you a hell of a lot of money. I mean, like I said, we've got one stock that's a 7-bagger right now and another stock that's a 12-bagger. We've already taken our investment capital off the table, so we're just letting them ride. And as they get too big, we trim a little more profit and maybe put that into something else that's higher risk, that looks like it's going to go a little further on down the line. And that's just how you make money in this sector.
Dave, how do you stay humble so that you keep making good decisions with your money? Are there is it some of those pain points of when you've lost
big
big
losers? No. Yeah. Oh my God, what was I thinking? Why didn't I see that? And it's like, you didn't see it because you can't see it. The things come up, happens that you can't see. But what you can do is you can have risk management tactics and risk management rules that you adhere to, so you don't lose a lot of money in any one position, and you end up, number one rule, right? The first 3 rules in investing is don't lose money, and don't lose money, right? So, I mean, that's how you don't lose money is you basically, you trim your winners, you hold your core positions, and if something is a loser and it's going the opposite direction of the market, you made a mistake, get out, sell it, get into something else. Right. And, as far as selling too early, I mean, I'm sorry, but, I've been in the sector now for 25 years almost. It's like, this is true more than any other sector. Is bulls make money, bears make money, and pigs get slaughtered. And I was a pig that lost a lot of my gains in 2008. Right, I remember going to the VRIC investment conference in Vancouver in January of 2008, and it was off the hook, right? I mean, there's young people running around. You never see young people at conferences. I even saw hookers, and you never see hookers at a mining conference, right? So I was like, you know what? I need to sell some. I think I sold 25% of everything or something. It's like, I should have sold a lot more, obviously, because look what happened in 2008, right? So it happened again in 2016. Early 2017, right? We had a big run up in 2016, and I took a bunch more off the table. But the move down was a lot worse. it wasn't worse than 2008, but it was, people thought that, hey, we're coming out of it. This has been a bear market for a long time. Sure, I should have sold more. But on the flip side of that, there were some things that I did sell that I shouldn't have sold. Some that went, like 20, 30, 40 times higher, and I missed out on it. But that's the sector, right? I mean, some things you're going to make a lot of money on. Some things you're going to lose a little money on. There's nothing wrong with losing a little money. You just don't want to lose a lot of money. And, the old saying is true. You just can't kiss all the girls. You don't want to sell something too soon and then chase something that's gone up that you missed, right? It's like, oh, this stock isn't doing anything. I got to get out of it. And I got to get into this one that's going up, and then, oh, wow, look, I did something stupid. I chased a stock and look, it's going down after I bought it. And then you feel like, oh, I made a bad mistake and I need to get out of it. And then you start second guessing. You can't do that. It comes down to buying fishing lines and selling rhino horns. And that's what you have to do. I mean, when a stock that you like, takes a fishing line move, you investigate why it's going down. It has nothing to do with the project, nothing to do with what management is doing, nothing to do with the rocks, the geology, nothing to do with that. Then it's an opportunity. And like I said, if you see something that's gone up too far, too fast, take some off the table. Take some profit. No one ever went broke taking some profit off the table.
So your confidence is grounded in humility and experience, right?
Absolutely. Absolutely, yes.
And you also, like, when you reflect back, you have to attribute your success to the right things. And I'll just use a baseball analogy, Dave, and you'll appreciate this because your son plays baseball too. When my son was just playing Little League before we got into travel baseball, the bats they would use, they were not composite. So you didn't hit the ball as far.
They use BB core bats when you get the older they get in the juniors, yeah.
Yeah, but when you get into travel, they use the composite bats, which add a little more flex. So literally the same swing in Little League with the wind not in your favor, it might go 180 feet. But my son hit one home run one of his first years of travel baseball. We got him the composite bat. Nice swing. He hit it really high, and the wind was pushing out to left field. Dave hit it 270 feet. That same swing with a different bat and the wind not pushing out would have been probably 180. And so you could say, what did he do different with the swing? He had a different bat. The wind was in his favor, and like those factors, you just want to acknowledge things beyond yourself, I guess is what I'm saying. Even when you're successful, you don't want to attribute everything. I'm successful because I'm so smart. You want to have some humility as you reflect back and say, I was successful because I had a good thesis going into it. But like with Discovery Silver, you said you made a 7-bagger since that transaction. That transaction wasn't even within the realm of possibility as far as you were concerned when you originally invested in in Discovery Silver. But boom, something good happened.
Because the management was Tony McCooch, right? Look what he'd done with Kirkland Lake, right? Look what he turned that into. And it's okay. This isn't going to be a single asset silver developer. They're gonna be getting something else, and it's probably going to be good. I didn't think it was going to be that good, but you really have to look at the jockeys. That's a big one. I know Rick Rule preaches this. It really begins with management. It does. I mean, I'd rather have a mediocre project run by a fantastic management team than a fantastic project run by a management team that doesn't know what they're doing.
Yeah, good point. Well, Dave, we've gone 38, 39 minutes. This has been an enjoyable conversation. We'll leave it at that. If you want to learn more about what Dave offers, go to Junior Miner Junky with a Y. He's got a paid-for subscription service. You look over his shoulders. He sends out a weekly email updating you. You see what he buys and sells. He explains to you why. And he also provides a lot of commentary on the market, specifically economics and geopolitics and how that affects the gold price. As always, Dave, Merry Christmas to you, and I'll catch up with you in the new year.
Absolutely. Yeah. Merry Christmas to all your subscribers, your listeners. And, thank you so much for having me on every month this year. It's really been my pleasure. I always enjoy talking with you. You always ask great questions. Sometimes I get nervous. I don't know what, some of these people are going to ask me. And, with you, I always know it's going to be something that's in my wheelhouse, and that I know a lot about. So thank you for that.
Thank you, Dave.